Welcome to Soluna's presentation of Q1 2025 financial results and business update. I am John Belizaire, CEO of Soluna Holdings, and I am joined by John Tunision, CFO of Soluna Holdings. Before we begin, I'd like to share a short legal preamble. The following content is completely qualified by the legal disclosures on the slide following this one. Our goal is to share with you some of our strategic thinking and financial analysis that we are using to guide the growth of our business. The content is in line with our principles of being accountable and transparent with our shareholders. We operate in a hyper-dynamic economic environment, and that's a fancy way of saying things change quickly. What we are telling you here is based on our estimates and assumptions, which are our best guess. We reserve the right to revise our point of view based on new information and changes in the business environment. Despite an uncertain, dynamic environment, we must plan and make operating and investment decisions, and this presentation lays out some of that for your review. This is the legal disclosure, and we'll stay on here for a second. Let's start by sharing an executive summary for those of you who are new to Soluna, and perhaps a reminder to our current shareholders. AI is the fastest growing technology today, with exponentially growing demand for compute and a corresponding insatiable demand for power and data center availability. Clean energy goes to waste due to curtailment, and there's a critical shortage of power for AI, HPC, and Bitcoin mining. Soluna bridges that gap, unlocking stranded renewable energy and turning it into scalable computing power. Co-locating data centers behind the meter at renewable power generation enables us to bypass long interconnection queues, improving power economics and accelerating time to market for this critical infrastructure. At the heart of the company, our mission is to make renewable energy a global superpower, using computing as a catalyst. We develop and operate digital infrastructure that taps into growing global opportunities, the convergence of renewable energy and high-performance computing. And we call this model, our approach to our business, renewable computing. Let's take a look at the operational highlights in the first quarter of 2025. Our installed hash rate sits at about 2.9 exahash. We have 75 megawatts operating. We are adding another 48 megawatts to that, so that'll bring us up to 123 megawatts spinning. And our goal is to grow over time, reaching over 698 megawatts under operation. This quarter, we closed at $5.9 million in revenue. You'll see more detail on that in John's part of the presentation here shortly. Our average power cost sits around $35 per megawatt hour. We consume a lot of wasted energy. We call that curtailed energy. We monetize that as part of our business model. We have consumed over 143,812 megawatt hours. We have access to a growth equity line that we secured and received approval on earlier this quarter as well. We have grown to 54 employees now. Our pipeline continues at 2.6 gigawatts, and our average efficiency of our miners is about 23 joules per terahash. In 2025, we are focused on 4 key initiatives. The first is developing our investments and focus on AI. We have repositioned the company to focus on joint ventures and partnerships that are essentially harnessing the value of our considerable and growing pipeline by developing AI and HPC data center joint ventures at these projects. We're also going to look to enhance expertise on our governance bodies, advisory boards, and our board of directors to incorporate AI and HPC expertise that will help us to support the expected growth strategy for the company. We are highly focused on the optimization of our projects. That's focus number 2. We are energizing Project Dorothy 2. That is the doubling of our core flagship project in Texas. We're going to be continuing to focus on the enhancement of the profitability and operational efficiency of our projects. We are constantly looking at customer mix and business model mix at our facilities to improve profitability in the short and long term. And we have a number of initiatives underway to improve overall customer satisfaction and the experience of our customers in our facilities. Capital formation is a big focus for us as well in 2025. We have a number of projects, and that list begins to grow now as the strategy and approach for our product and our curtailment solutions are proving out in the marketplace. We have a number of power partners that are coming and calling to work with us. So we're pursuing financing opportunities to support those growth initiatives, including projects like Project Kadi, our most shovel-ready project now, Rosa, which is maturing. We're also leveraging the strength of our project-level cash flows to either refinance or pull forward values of existing projects and to deploy debt and financing into new projects. And the last area is continuing to grow our pipeline. As you can see, we're making fairly considerable progress on that, up from 2.6 to 2.8 gigawatts. We're increasing the number of curtailment assessments that we are completing with power partners, and we're also advancing more projects to the shovel-ready stage, essentially through the execution of project term sheets and also the development process in the ERCOT area. I would now like to take you through the operational highlights at our various operating projects. Let's start with Sophie. There were 4 key highlights from last quarter. We achieved a 16% improvement in our hash rate from Q1 2024 to Q1 2025. The customer mix also was changed. As I've mentioned, we've been focusing on managing customer mix size to achieve better performance and profitability. We did do that at Sophie. We also experienced an unplanned outage due to severe weather in the Kentucky region that brought down the substation that Sophie was connected to, and that impacted, as you'll see going forward, our revenue and operational activities at the project in the last quarter. We did sign a debt deal where we refinanced the project, essentially taking some of our forward cash flows and using those through that debt facility to then invest in the new project development activities we're focusing on. We were trying to focus on non-dilutive debt, and Galaxy Digital was able to put together a great partnership for us there. Now, taking a look at Dorothy 1A, we migrated 20 megawatts of the 25 megawatts at Dorothy 1A of customers from a volumetric pricing model to a profit share model. John will walk you through the difference between those, but essentially we changed the business model in that project, and we'll show you the financial effects of that and a look at the future of what that might drive. The second, we changed the mix of customers to achieve better performance and long-term profitability at this site as well. And we did experience a planned outage at Dorothy 1A that was related to facilitating the interconnection of Dorothy 2 as we were connecting in the electrical infrastructure for that project to begin its energization process. Next is Dorothy 1B. This is our project, 25 megawatts joint venture with Navitas Global. The first highlight is we did pay off on time and in full the Navitas project level term loan. That's now balance 0 and no debt at the project. 2, we did as well take down Dorothy 1B when we were doing the Dorothy 2 electrical infrastructure interconnection. And finally, we had some minor performance issues after a winter storm that hit the area. It was a freak storm with high winds and a real cold snap that affected the performance of this facility in this quarter. And of course, Dorothy 2, we are on track for the commissioning of the first of 3 phases, 16 megawatts during this coming up month, May 2025. We have about 1/3 of the site capacity sold or under signed term sheet. So we're making progress on the customer development activity for the project as we ramp up. And we've also started deploying some initial customer machines at the site as we ramp up that first phase. We've been busy this quarter. Here are our accomplishments on the business and project side. On the business side, we secured a $5 million non-dilutive debt financing deal with Galaxy Digital, as I mentioned before. That's connected to the Sophie project. We completely converted all of the convertible notes in late 2024 and have brought that down to a zero balance. We made a strategic exit out of the HPE partnership. That's where we're providing GPU as a service through that relationship. We've now moved to focusing on our infrastructure, building projects, and ultimately data center infrastructure for future AI partners. We also received our second patent award related to technologies that we've developed around thermodynamics in our data centers, and we're very proud of that. On the project side, we've been equally focused and busy. A number of new projects were announced. Project Rosa signed a term sheet, Hetty signed a term sheet, and Project Ellen. That's 187 megawatts, 120 megawatts, and 100 megawatts, respectively. All a fairly sizable improvement in growth in our pipeline. Our long-term pipeline continues at about 2.6 gigawatts. We also monetize a large amount of curtailed energy, as I mentioned earlier, over 140,000 megawatt hours. And Project Kadi has reached shovel readiness as we completed a number of the key elements to getting a project like that ready to build out infrastructure. And one of the things that we completed this quarter was to secure all of the land we need for both the Bitcoin hosting projects that and implementation we're going to be doing there, and also future AI JVs at the site. So 100 acres have been secured through signed agreements that we've done, and we hope to close those transactions here in the coming quarter. This is one of my favorite charts here. It shows all of our projects. You can see the first 3 rows represents our existing operating projects focused on Bitcoin hosting and mining. That's our original 75 megawatts. We're now expanding that with Dorothy 2, adding another 48 megawatts of hosting to the project. And all of these projects, we've had partners or joint venture partners financing and supporting us in the growth of those projects, and pretty proud of that. What's even more exciting is the expansion of the development pipeline. Kadi, Rosa, Hetty, Ellen, all of those projects are north of 400 megawatts. And the exciting thing is that when you put those together, we're talking about 698 megawatts of data center capacity that is either in operation, under construction, or development. That is a material expansion over the last couple of years, and we expect that to continue in the coming quarters. Let's take a look at what's ahead for Q2. Of course, we are going to continue to energize Dorothy 2. The first phase of that project, 16 megawatts, should complete within the quarter, and we'll begin to ramp each quarter from there to complete the full ramp by the end of this year. We also have project level capital formation progress we expect to make in this quarter. We have a number of activities related to project level partners underway. We'll be attending the Bitcoin 2025 conference for customer development activities for D2 and some of our other upcoming projects. as we build this expanding pipeline of new projects, there's been lots of customer interest as people look for infrastructure places to land their equipment. Pipeline continues to expand, and new project announcements we expect to make as well. We have a number of IPP conversations underway. A lot of that has been driven by our success with some of these big infrastructure partners like EDF and Masdar, and new partners have reached out to us about working together. New Project Dorothy customer announcements will also be something to look out for in this quarter. We mentioned earlier we have some term sheets signed, and we expect to complete definitive agreements this quarter as well. And of course, development work will continue for Rosa and kick off for Hetty and Ellen as we move those projects through the studies and engineering process and the ERCOT planning process to get them shovel-ready for new capital formation activities. So stay tuned. There's lots more to come, and we look forward to telling you more as those developments take place. I'd now like to turn the presentation over to John Tunision, who will walk us through the financial highlights for the first quarter.
Thanks, John. I'll now walk through the financial highlights. So the most significant driver of our Q1 2025 performance is changes in revenue and gross profit. And there's a number of drivers of these, and there's some complexity to it. So I'm going to first kind of walk you through what the drivers are at a high level, and then I'm going to go through each of them in some more detail, the goal being that you understand what those drivers are. So there's really four, and I'll talk in more detail later about three in particular. So the first one, as most of you are likely aware, is the fact that the Bitcoin halving happened and the movements over the last year, essentially in the hash price. And those did have a significant impact on our results, in particular when you look at Q1 of 2025 versus Q1 of 2024. So I'll come back to that. We also made a strategic decision to switch part of our customer portfolio from what we would call volumetric contracts to profit-sharing contracts. And I'll come back to that and talk through those in detail too. And that had a significant impact in revenue, no impact to gross profit, and I'll unpack that later. Then additionally, we had outages. These were, in one case, an unplanned outage, that being at Project Sophie due to weather. And then we had a couple of other outages that were for what I would call positive reasons, normal course, but I'll talk about those in a bit. And then there's the demand response, and there was a year-over-year change on that. So let me go into some details on these. So first I want to talk about that shift in our contract model. And we went from, as you'll see, a 50-50 split based on megawatts of what we call volumetric contracts and profit share contracts. A volumetric contract is a fixed price based on the electricity usage plus some service fees, whereas a profit share contract passes through the power, passes through some of the OPEX, has some service fees, and then has a significant Bitcoin profit share, which is actually the profit of the customer after paying their fees to us. And so, as you can imagine, these two different models have different response due to factors like hash price going up or down, or electricity going up or down. And they also look a little bit different in our financials. And one of the models is not capped and the other is. So let me go through those. With a volumetric model, as you would expect, it's not tied directly to the customer profitability, so not tied to the Bitcoin that they're mining or the value of the Bitcoin. And therefore, hash price movements up and down really don't have an impact on Soluna's revenue. Electricity, however, because again, you're talking about a fixed fee, When electricity cost goes up, that is something that Soluna bears exclusively. And when it goes down, that's a benefit to us. So you do see gross profit movements up and down. The other significant impact and why it's something we're talking about this quarter is, and this is a one-time impact, when you move from a volumetric model, you're no longer including costs of energy in your build revenue, and therefore your revenue has a step change down, but you're also step changing the cost of revenue at the same time. So they basically cancel each other out when you get to gross profit. So there's no actual impact to our profitability, but there is an impact to both the revenue and cost of revenue lines. The other thing that a volumetric model has is some theoretical cap. There's a limit to how much power could be consumed for a given volume of miners consuming a certain megawatts of power. And therefore, there's a limit to your revenue that you can generate. So the strategic shift involved diversifying our mix of customer contracts, both because it's good for Soluna, but also because it's actually preferred by the majority of the larger Bitcoin customers that we work with. So when you have a profit share model, as you would expect, anything that causes the customer's profitability to go up or down also causes our fee to go up or down, just to a lesser extent. So if hash price goes up or electricity cost goes down, that's good for our customers' profitability, that's good for our revenue. And the vice versa is true. If hash price goes down or electricity goes up, that causes our revenue to go down and our gross profit to go down. There is, as I already talked about, no electricity built into the revenue. So like for like, the revenue reported is lower, but so is the cost of revenue. And importantly, there is no cap to the profit. And this means by diversifying our mix of customer models, we get to participate in some of the upside of Bitcoin while not exposing ourselves completely to those economics. On the next slide, I'll show you a hypothetical example of what the curve of sort of revenue and profit look like for those deals. So again, this is showing you that the mix has shifted from approximately 50-50 at 25 megawatts each. And by the way, this is between our Sophie project, which is all Bitcoin hosting, and our D1A or Dorothy 1A project, also hosting. And we've switched at those two plants to a 45 profit share, 5 volumetric. Now, we could see in the future, we may choose to do some additional volumetric contracts, let's say at Dorothy 2 or Project Kadi. So I wouldn't expect these ratios to necessarily remain fixed. What I think you will see is they'll remain balanced and we will vary them over time. But these curves are meant to represent, the blue curve being the profit share, where at a lower Bitcoin or hash price, which is the left of this chart as you're looking at it, you can see that maybe there's less revenue earned. And that happens to be the environment we're in Q1 of 2025, which is part of the driver of why our revenue and gross profit were down because of this. But in the future, you could imagine as Bitcoin price rises and or electricity falls, there is no cap and the profitability on these deals could rise substantially. Whereas with a volumetric deal, it's much more a constrained case where at a certain point, you reach the maximum potential for that deal. So hopefully that helps you understand a little bit more what the drivers are of that decision. And to bring it to light and help you see now how we've looked at the Bitcoin halving and the hash price movements, on this slide, I want you to look at these curves and see that a few things. One, as you probably already know, the relationship between Bitcoin price and hash price, I would say they are highly correlated for obvious reasons, but they're not identical. And there's some dampening effect. And hash price is very much going to be constrained by various other factors related to the Bitcoin process of adjusting the algorithms and the rewards, and it has to do with the amount of hash rate that's online, and the economics drive that. And there's a lot of complexity there that I'm not going to go into at the moment, but clearly there's a relationship, but they're not directly one and the same. And what you should see is that our gross profit also does correlate quite closely, more, I would say, with the hash price than the Bitcoin price, in particular looking backwards. And this relationship has driven, if you look at where hash price is relatively speaking, when you compare Q1 of 2024 to Q1 of 2025, you can see how there has been a negative impact of hash price in particular, given that Q1 of 2024 was sort of what I would call a peak in hash price, whereas now we're closer to a bottom in hash price. And also goes without saying, this entire period is the first 5 consecutive quarters that Soluna has been operating all 75 megawatts of its facilities at Sophie and Dorothy. So you're seeing the full impact over a complete annual cycle. So I talked about 4 things that drove revenue and gross profit and said that I would talk in more detail about 3 of them. I just covered the first, being the halving and the Bitcoin hash price. Now I'm going to talk about outages. And we had a range of types of outages. So I'll start with at Sophie, we had a 3-week partial outage. And this was caused when some severe weather came through and essentially dropped some vegetation on the substation and caused some significant equipment damage. The good news there was we were able to work with our power provider and restore partial power very quickly within a week. And we actually reached over 50% capacity fairly quickly thereafter. And by helping to locate necessary equipment together with the power producer, we were able to, get to where we were restored within 3 weeks. But that did cause us an outage, and there was lost revenue and gross profit there to the tune of a couple $100,000. So then it comes to what I would call our positive or planned outages. These are things that were needed to do that we did for good reasons. I'll start with the one on the right, the planned outage at Dorothy. In order to connect Project Dorothy 2 as part of the commissioning process and part of the energization process, it required us to take an outage at Dorothy 1 while the key electrical interconnections were made with the Dorothy 2 assets. So that was very much expected and planned, but does cause a small loss of revenue and gross profit, $300,000 of revenue and $200,000 of gross profit in this case. The final and larger driver of outages was we intentionally, at both our Dorothy 1A project and Sophie, as part of our normal and expected routine maintenance of our customers, turned over a couple of customers. And we do these for a variety of reasons. In general, if we feel that we can bring in a customer who maybe has newer equipment that will operate better, that will achieve better efficiencies, and ultimately generate more economic value, then that's a good reason to do that. And we had those reasons in a couple of different cases. So when you change out customers, although we plan carefully to try to minimize the amount of downtime, there's inevitably a period of time while you're ramping down one customer, deracking their equipment, and then the other customer is shipping in and you're staging that equipment, racking it, energizing it, doing your quality checks, and eventually you get fully online with it. So that combination across those 2 plants, all of which happened during the first quarter, caused us to lose approximately $800,000 of revenue, which was another key driver. So now that I've walked you through the details of the key drivers, I'm going to show you a series of slides. There's going to be trend charts as well as some bridges where you'll be able to see in numbers what I just described in words. So the first one that I'll start with is the revenue trend by quarter. And here you can see from a peak a year ago in Q1 of 2024, where we were 12.5 million of revenue, we're down to $5.9 million of revenue. And again, the drivers of all of that are the factors that I just talked about, and I'll go through them here in a bridge on the next slide in some detail. I think that'll help you to understand, why this financial trend exists. And I think a key takeaway, especially on the revenue, that you should have is the year-over-year impacts of halvening are basically now, with this complete annual cycle over with. That's one factor. Second is you've got fully the 75 megawatts that we've had online across all of the future comparative periods, and we're now on the cusp of starting to energize new megawatts. And that's really our strategy for how do we regain revenue to the levels that we had achieved pre-halving with the full 75 megawatts up, which was what Q1 of 2024 was. So we're excited about, and we'll talk more about energization of Dorothy 2 and kicking off of Project Kati, and we'll be energizing those plants, as soon as we can. And with that, and turning on that number of megawatts, you'll see that as we go forward together with the changes we've made in the customer contract mix and the outlook for Bitcoin and hash price, which, you're free to have your own outlook, but generally I think consensus is that it's likely to go up. I think all of those will combine to cause our revenue to grow pretty sharply going forward. So to bridge for you the four things that I already talked about, three of them in a little bit more detail, I'll hit the first one, the halving. Obviously, there's a lot of complexity that goes into post-halving versus pre-halving hash price. I talked about some of them. There's the algorithms adjust and the amount of hash rate online adjusts as, various machines become uneconomic. And, there's a lot more detail there. But independent of that, generally speaking, you cut the Bitcoin reward in half, you're having the economics. Well, the impact that we can see quarter over quarter, strictly speaking, related to the halving and hash price specifically, is almost $4 million in total. And this is across our whole portfolio of 75 megawatts. Then you can see that the contract type change, when looking at it from a revenue standpoint, had a $1.1 million impact to the negative. Again, keep in mind, when we look at this from a gross profit standpoint, it had no change or no impact. Then you've got both the customer on and off ramping and the substation outages. Those two I talked about together. Those combined is a $1.2 million impact. And then you've got lower demand response, which was 370. And although I didn't go into detail, we've talked about what this program is. I encourage you to look at some of our past posts about that, and we're always happy to answer questions about it. But that program is gaining traction. And as other producers and potential entities who can also participate in that program learn about it and its benefits, there have been more megawatts essentially pledged in that program, which reduces the overall revenue that can be earned by pledging a certain number of megawatts. And that's indeed what we've seen. So we've had some lowering of the demand response as a result of that. So if we pivot and we look at gross profit by quarter, gross profit is very closely related to our revenue. It is essentially taking the largest cost that we have, the electricity, off of that, but the shape and the trajectory of it is very similar, and so the drivers are very similar as well. And this declined right along with, and those same 4 million of having impacted our gross profit. The same downtime that I talked about impacted the 1.2 million, and the demand response also impacted. What didn't impact it, of course, was our contract changes, as I talked about, because that reduced our cost of revenue as well. And here's that shown in a bridge. You can see the exact same bridging items, except that the contract type change at Dorothy 1 is essentially zero. General and administrative expenses. So I think it's important to unpack this a little bit. I tend to think of them as CFO of the company in a couple of buckets. One are what you would consider to be the traditionally very controllable, very highly managed expenses, things like the people and the services and IT expenses and communication expenses and travel that come along with, the people that we have in the organization and kind of a base level of running the business. And we're very happy that we're able to control those expenses very clearly. The expenses that did cause growth year over year from first quarter of last year to first quarter of this year are one, a stock comp expense, and this is a function of our compensation committee's plans that are put in place and accounting for those as equity awards and things like that are trued up and topped up. So that's a kind of what you should view as a one-time expense there. And then the professional fees are really the lion's share of that is legal expenses. You can see the number of things that we've done in conjunction with convertible loan notes coming out, modifications of our preferred B, in particular the SEPA facility with Yorkville and associated documents and things like that, modifications with our cloud loan provider, Green Cloud, and so on and so forth. So those legal expenses are the largest driver of the $800,000 of incremental legal and professional fees quarter over quarter. So you add it all up, and I think it's important to note EBITDA itself actually goes up or becomes less of a loss when you look at the progression. You can see it here from Q3 to Q4 to Q1. And the biggest single driver there is, as we announced, and I won't go through all of the details again, but our termination of the HPE contract resulted in us essentially booking all of the financial impacts of that termination in 2024. And so in Q1, as expected, and that will continue, there's less of a drag on EBITDA as a result of that. And so fundamentally, this does show you that despite some of the fluctuations in revenue and gross profit related largely to the Bitcoin economics, the fundamental business itself continues to improve. And that's a metric that we like to look at as very, it's sort of the canary in the coal mine about the health of the company and how it's going. And pleased to say that is going up. The next two slides just shows you, this one is Q1 of 2025 and the next is Q1 of 2024, the breakout down to the gross profit level of our individual projects. So for those interested, you can see how each of the projects is contributing and some of the nuances of the revenues being booked and the classification of those and the types of cost. But again, I won't rehash through this, talked about in general. The overall driver of these economics is largely the hash price and the halving impact, with some outage implications at a couple of the projects. And then, to a smaller extent, the demand services. And again, the customer model shift did not impact gross profit, but did result in a change in revenue and the cost of revenue between those two lines. Again, this is the comparative period. Now, the next one I kind of hinted at, and so I'll go into some detail. And let me first say this is very illustrative, right? So I'm not trying to present this as a revenue forecast, and you shouldn't take it as that. You should take this as, on the left, what you're seeing is a potential ramp rate of the megawatts that we have in operation. And this is as we bring our Project Dorothy and Project Kati online over the coming quarters, and what that'll do to our capacity. And this also looks backwards, of course, to the beginning of last year. Now, if you were to make an assumption, which may or may not be the correct assumption, I think it's a reasonable one, that you take the average revenue per megawatt for the last 3 quarters, that being third quarter of 24 through this last quarter, first quarter, and you apply that average to the megawatts as they come online going forward, you can see on the right that by the end of next year, we would build to a quarterly run rate of approximately $20 million of revenue per quarter. So I thought it was important to show that for two reasons. One is to give you an idea of how this business and how our strategy deals with halving and how we regain revenue, over a period of time, and also to give you an idea of, what the project announcements that we put out and when we talk about signing new projects and getting into development and bringing them to shovel ready and then constructing them. This is the kind of uplift that would be expected to have on our revenues and therefore our profitability.
Thank you for taking the time to learn about our results in Q1 2025 and plans for the rest of the year. John and I want to thank our shareholders, investors, customers, and partners for their continued support and patience as we execute on our strategy. Please connect with us to keep up to date. You can find us on X. We're handle @Soluna Holdings on X. On LinkedIn, you can search for the Soluna Holdings page. And if you haven't joined our newsletter, I highly recommend you do. We have thousands of subscribers that enjoy content that we put out that covers our business, interesting technology developments in the data center, AI, and Bitcoin hosting space. And we also run a number of other channels, our podcast, our blog, and other resources that can help you understand our business and how all of this is shaping the future of computing. Thank you for your time. Until next time.